What if I told you that the richest man on earth is on track to receive a paycheck, not for millions, not for tens of billions, but potentially close to $1 trillion? And what if, while the average person is dealing with rising costs, job uncertainty, and inflation that eats away at every paycheck, a single compensation deal could redefine what corporate power really means in America? Pause for a second, because today we're recutting through the noise to look at the full picture. How a performance-based reward became one of the most ambitious, controversial, and misunderstood compensation structures in corporate history. If you're new here, subscribe, stay tuned, and get ready. Because once you understand how these financial mechanisms work, you'll never look at executive pay, corporate value, or innovation incentives the same way again. This isn't just about one person's earnings. It's about how modern capitalism rewards extremes, redistributes risk, and reshapes who truly benefits when companies chase trillion-dollar dreams. Are you ready? Let's begin. In the early 20th century, corporate boards were small. Shareholders had little voice. Top executives were trusted to run companies with minimal oversight. The idea was simple: pay big, expect big results. Fast forward to the 1980s, CEO pay skyrockets. Stock options become the norm. The new philosophy: if the company wins, the CEO wins. But when the winning depends on inflated valuations, or when growth is driven by unrealistic assumptions, the balance breaks. By 2008, that imbalance collapsed spectacularly. Executives earned massive bonuses built on fragile profits sustained by complex financial engineering. The result? Bailouts, layoffs, and economic pain that ordinary people paid for. Sound familiar? Now in the 2020s, we see history repeating, but on an entirely new scale. Tesla's market value sits among the highest in history. CEO Elon Musk was granted a compensation plan that could, if all targets are met, reach nearly $1 trillion in value. Official story: a deal to push the limits of innovation, sustainable energy, and human progress. But beneath that story lies an intricate system, one that links pay, valuation, and power in a way that transforms incentives and risk-sharing itself. Because while most companies measure performance by profits, these mega deals measure it by valuation growth, a dynamic that can amplify both success and risk. In 2018, Tesla's board approved a 10-year performance award valued at around $55.8 billion at the time. Later reports projected that under certain conditions, the total potential payout could surpass $1 trillion if Tesla reached a market cap near $8.5 trillion, producing 20 million vehicles and launching large-scale robotaxi operations. To some, it's visionary. To others, it's financial overreach. But either way, it raises the same fundamental question. When executive pay is tied to nearly impossible targets, who truly bears the risk? Keep that question in mind, because next, we'll look at how the mechanism itself works and how its hidden leverage reshapes corporate behavior. Here's the twist. These compensation plans aren't just big pay for big performance. They're structured like financial derivatives, instruments that amplify both gains and losses. When Tesla's board approved Musk's plan, it set valuation milestones so aggressive that they effectively turned the company's future into a leveraged bet. If Tesla hits the targets, Musk earns shares worth hundreds of billions. If not, he earns nothing. That sounds fair until you realize how it changes incentives. Suddenly, the CEO's goal shifts from steady growth to rapid valuation acceleration, because every increase in market cap unlocks a new tranche of reward. This isn't about quarterly profits anymore. It's about perception, hype, expansion, sometimes faster than fundamentals can support. And when these kinds of structures spread across corporate America, something subtle but powerful happens. Boards start rewarding valuation velocity rather than long-term value creation. That's the turning point. Because the faster the company grows or appears to grow, the closer the payout gets. But here's the catch. To reach those astronomical numbers, companies often have to issue new shares, expand into risky sectors, or stretch their balance sheets. That means dilution for shareholders and rising exposure to risk. And you'll soon see, the deeper you look into this mechanism, the more it begins to resemble a feedback loop of extraction and leverage. Next up, the numbers, the legal battles, and the governance story that might just redefine how corporate power operates in the 21st century. Let's break it down step by step. Tesla's 2018 plan granted Musk roughly 303 million stock options at a strike price near $23 per share post-split. To unlock them, the company had to hit a series of revenue, profit, and market cap milestones, each worth a separate tranche of options. At the time, Tesla's market cap was about $60 billion. The top milestone? $650 billion? That's a near 1,000% increase. Fast forward, in 2024, the Delaware Court of Chancery reviewed the plan and called it unfathomable, citing concerns about how closely Musk influenced the board that approved it. Yet despite that ruling, a new version was introduced, one even larger. Reports indicate that under the revised terms, the potential value could exceed $1 trillion if Tesla achieves a market cap of $8.6 trillion, delivers 20 million vehicles annually, and reaches 1 million robotaxi units. These numbers are staggering. To put them in perspective, Tesla's lifetime net income to date is still less than the value of Musk's earlier $55 billion package. So what are the risks? Dilution. If the targets are hit, new shares are issued to fulfill the reward, reducing other shareholders' ownership percentage. Governance. Because the board's independence has been questioned, critics argue the plan prioritizes one individual's reward over shareholder alignment. Moral hazard. With such massive upside, the CEO's incentives may favor aggressive valuation growth, even if it strains long-term stability. Imagine it like this. If a homeowner agrees to pay a contractor only if the house's value multiplies tenfold, that contractor might focus more on quick market appeal than structural integrity. That's what ultra-leveraged compensation plans do. They push leadership toward market momentum, not necessarily business fundamentals. And when the market cools, the downside doesn't vanish, it just transfers to investors, to employees, to the public markets that hold these stocks in pension funds and index portfolios. That's why regulators and courts are now scrutinizing these deals more closely than ever before. Because at a certain scale, this isn't just about one company's compensation, it's about the architecture of financial risk itself. Here's the reality. The mega compensation era isn't an isolated event, it's a blueprint spreading across industries. It reflects a system where executive rewards scale exponentially, while accountability struggles to keep up. And when growth slows, valuations correct, or targets prove unreachable, the imbalance is revealed: dilution, loss of confidence, or governance crises. The question isn't just, is this fair? It's what happens when the targets fail. Because when valuations are built on expectations instead of earnings, corrections can be severe, and the people who pay the price aren't usually the ones in the boardroom. This is why understanding these mechanisms matters. It's not about villainizing one individual. It's about understanding how compensation, valuation, and governance intertwine to shape the modern economy. So, as investors, as citizens, as participants in this system, we need to ask, are we rewarding innovation or incentivizing imbalance? If you believe financial power should come with accountability, if you think shareholder value should mean more than stock price, then share this video. Because awareness is the first step toward change. And when the next market shock hits, you'll understand exactly where the cracks came from. This video is for educational and informational purposes only. It is based on publicly available data, court documents, and news sources such as Reuters, CBS News, Barron's, and Electric. It does not constitute financial advice. If you found this video valuable, don't forget to like the video and subscribe. It helps the channel grow and keeps you updated with more deep dive investigations into the truth behind money, power, and influence.